Well, hello, folks. Welcome to another Market Masters session with you. Joe's with you, I should say. Market Masters session 7. We are getting into range-bound trading. This is a different type of strategy. It's basically the combination of everything you've learned up to this point put together in what could be a smaller time frame. So let's get into it. So folks, before we start getting into things, just got to make sure you know what you're doing before you do it. One thing is you can revisit these classes as many times as you'd like. Make sure that you do to make sure that you get them down and take responsibility for the outcome. If you don't like how things are going, you can always change your trading plan. Right? So speaking of which, there are thousands of ways to do this. I love this slide. You've seen it a few times, but I'm going to go over it again. Backtest, try, use some of Maverick's theories, make up some of your own, build upon it. Keep that in mind that there are variations to this based on your own preferences, and they can be correct. This is where you can work with your coach to see some things you might like or some things you don't. So range-bound trading, why does this work? Well, I'll tell you, it is just like everything we've learned all put together. Most market conditions, you see an uptrend or a downtrend. Sometimes you have a stock that you don't know what it's doing, and you actually base upon moves. And that's what we're going to be focusing on. I'd really like to see you guys think about this as a move is from a bottom to a top, a high pivot to a low pivot, and back again. That is a move. What creates a trend is the connection of those moves if they're increasing or decreasing. So when it comes to range bound, you identify moves. And if you see that some of these moves have the same highs and lows, you've created yourself a range. Now there's a difference between sideways trading and consolidation. And we'll illustrate that in continuing classes. Clear entry points, once you see this thing hit a few times to the upside, or the stock hit a few bottoms, double bottoms, triple bottoms, double tops, you guys have heard of all those, you can use those as entry points. We're going to be using basically the bull pullback and the bear rally. So keep that in mind. Formation of high pivots and low pivots. What's cool about identification in a sideways or a range-bound trading stock is that you can get an idea of where you can expect it to stay over a certain amount of days. Two things that are cool with this: the time frame is a little easier to figure, right? Because you're just going to take the time frame of each move and kind of average them out. And then, knowing that you are taking advantage of sideways, you can use your option strategies to take care of that and play a game to where you're making money with sideways move. It's a nice way to balance a portfolio. So I don't want to get too far in my head, too far ahead of myself here, folks, because we need to identify the pattern first. So there's no real, you need to identify major support and resistance, and you need to see that it hits consistently. You can see these lines that we drew, and you can see a few of them where, okay, it's a solid candle that hit to the upside, we'll say around 22. We're going to use this as our example, I believe. Then you can see, like, further back, mid of this chart, you can see it shadowed through 22. It's an area. You want to see, it doesn't mean to be exact science here. We just need an area of where this thing has turned more than once in a sideways range. So let's get into it a little deeper. Once again, we have our handy dandy sheets. What I love about this is going to be called the range pullback. And take a look at the illustration on the worksheet itself if you kind of get confused. You can see that we have multiple highs and multiple lows, but you can see that we're playing this off of the bottom. So guys, I want you to kind of click your brain into bull pullback mode, because a lot of the bull pullback that you learned is going to be implemented here when it comes to the pivot on the support level and the confirmation to the upside along with the target. So it's going to be very similar. Why we get into the range side of things is because we're going to need to give it a certain amount of time, because this isn't a continuation of an uptrend. This is the beginning of an up move back to a resistance. So it's not as aggressive of what a bull pullback could be when it comes to targeting and time frames. We're actually a little bit restricted since we're already establishing a range. So let's continue with this example and figure it out. Now the other thing is, as you might have expected, we have the opposite. Take a look at the illustration on the worksheet. It's showing basically a bear rally, hitting the higher part of the range with the idea to trade it downward. Pretty cool, right? Now, some of you guys should be thinking about your secondary indicators. Bollinger Bands are really nice in these situations. Watching the moving average just cross back and forth or flatten is a really good idea. MACD, stochastics, increase of power, decrease of energy, increase of trend, decrease of, I shouldn't say trend, but move. Really, really nice to have some of these secondary indicators in your court when you come to these range bounds. Okay. Below this video are those worksheets. I would suggest starting once again with the Maverick ones that are all filled out the Maverick way. Play with it until you're blue in the face, and then you can make it your own once you get pretty good at it and get an understanding of what you're looking for. So let's start with our first case study. This is Mosaic. And we're just going to break down our worksheet section by section. So the first thing we have to do is analyze, is there no trend? And you know, guys, just by looking at it, and these are kind of fun, because you're going to get used to seeing charts. You're going to get used to identifying charts as you go through our curriculum, your program, and just a time behind the seat, right? But when you take a look at this and you kind of scratch your head and you're trying to find what trend this is in, you found yourself a range. Very good. So the next thing you need to do is identify some of these pivot points and see if there's any in common. Now, guys, you can see that there might be all over the board. There might be some higher than others, some lower than others. You might not have yet got a strong established side or range yet. So keep that in mind. You want to see consistency in these. No matter how many times, how many periods you're looking at, whether it's a daily, weekly, 15-minute chart, you need to see consecutive, at least two. I'd like to see more than two support and resistance areas. In this case, we've identified one of each, which is 2. So we've got an established range. The other thing is the flattening 20-day and 50-day SMA. Now, folks, you can see that this 20 and 50 are the 20's all over the place. It keeps crossing back and over the 50. That's a good sign because that 50 is pretty much flat. And what I'm referring to on the chart, folks, is the blue line versus what is that, an orange line, I believe, some reddish orange line as they cross back and forth. Now, the difference between consolidation and sideways is if those moving averages are trying to catch the price action, which I explained in the intro before this video. But this is a very good established range trade. Equal highs, equal lows. We want to make sure that we find those. So there's the pivot points, and you can see that they are equal or close to. Now we're going to identify about that price, right about the specific average price that those are at. And there are a few, if you can take a look at this. So let's get started here. So stocks moving between support and resistance, we find an area. Notice that $22 and about $18.25. I love the fact that we drew these bars instead of specific line because these bars show that, hey, there's like what I want to say about like a 70 cent or 50 cent variance in between those, in between the high and the low of each one of these margins. That's fine. It's an area because we just need to be close. We don't need to be exact. But what's neat is since we drew this, I can actually see 3 times that the high has actually hit inside that box. 2 were pretty close to each other, and that last was the shadow. I can also see the same 3 or 4 times on the bottom side. 2 side by side in the middle there. You got a doji, next one over, and then closest to the far right, where we're actually looking for our setup and our confirmation. The stock is currently back into it. So let's not go too far yet. Let's keep going with our moving averages. Yes, they're flat, they're slope, and showing no clear trends that is in place. This is not uptrending, it's not downtrending. There's no way to see it. We see the pullback has brought us into the 1825 range, right? It's down in that area, so that's a good thing to see. We also have a reversal cattle pattern. What that is a bullish harami pattern. What you have is a red candle, and inside of it is a green candle. It's a bullish harami, and harami means pregnant, I think. So pregnant with a bull, which is a sign to reverse to the upside. We still need confirmation, right? So we'll look for this trade trigger. So we need to see bounce off, establish that it does establish the pivot point. Remember that. And trade above that harami high or the green candle's high. That is going to be our confirmation. So folks, do you like to get in first or do you like to get in after? Meaning as it confirms, I'm going to get into the trade, or after it confirms, I'm going to get into the trade. There's no wrong way to do it. You've seen this slide a bunch, haven't you? You've seen this slide every time we've taught these patterns. So keep that in mind. It's going to be a reflection of your personality Over 1,000 trades, there's no advantage to either one. Just depends on what you like to do. So let's set up our time frame, entry, stop, and target. The first one is time frame. And this is cool because we have an area, the $22 area and the $18.25 area. All we have to do is measure how long it takes to get to each one. So here's the first move between the two support levels. This took 12 days. All we did is just starting from that first candle and how long did it take to get down to the bottom. Then we do it from bottom up. Now this took 20 days because if you take a look at its first move up the bottom, it actually came back and revisited support, didn't it? About 8-10 days in there, it revisited, and then it shot up, back up to resistance. Same idea when it came back down. Came down a little bit, went back up, retested that resistance again, then fell. So you can see the first move was 12 days. These last two moves, 20 days, 21 days, took a little bit longer. Now this last one was pretty quick because it didn't quite get to the range at the very bottom, and it didn't quite get to the top. Well, it almost got to our top point. So we included, okay, well there's an 8-day move here, and let's take a look at the 8 days it took to move on the downside. Now folks, I'm actually okay if you combine both those 8 days and made it a 16-day move because it actually did touch our bottom area on those days, on that day. So you could have that as one big move. I'd be fine with that. Now all you do is add up these numbers and divide by how many sample sizes we took, or samples we took. So it looks like you got 12, 20, 21, 8, 8. It's like 69-ish, I think, 60-something, 69. And you get 1, 2, 3, 4, 5 measurements. You see how we did that? So 69 divided by 5 gives us like 13 point something, I think. So we just gave it 14 days. Plain and simple. Now I went through that very slowly, but hopefully you guys can see that it's actually super easy to do because you're just measuring and counting candles from top to bottom and then from bottom to top to bottom, and do it as many times as you want, as many times you saw it hit when it correlates with your entry point, right? So there it is, 14 days, plain and simple. Now we got to get to our entry, which is going to be 1875, and all that is the high of our reversal signal. So we are going to enter as it confirms. We're not going to wait for it to confirm and then get into it. Remember, folks, doesn't matter after 1,000 trades. You just got to make sure you choose one and do it the same way every time. So we got an entry point at $18.75. Now we're going to go ahead and put our abandon and stop point at a major support level at $17.50. Now imagine this major support level could have been off the screen, but it's also an area where the stock hasn't broken below in a while. Remember, different ways of choosing stops. We have a class for that. Right? You can use trend lines, adjustment, ATR, previous lows, support levels, moving averages. In this case, we're using a support level, a major support level at $17.50. Our target, pretty easy, right? We're going to go off the previous high. I'm actually okay if you guys want to go back up to the top of the range. Now, the reason why I like this 2150 is because it's been there before recently. We don't want to choose the specific top of the range because remember, this is an area. And if we had the $22 as our target, you can see that the 3 times that it has hit it in this chart, if you look to the left with that huge spike in that green candle, it actually hit 2250. You wouldn't want to use that as a target because it only has done that once. The average we kind of figured was around 22, but if you want to make sure that this actually gets there, you lessen it. You don't want to be the absolute high. All we're trying to do is cut out of that greed factor so we don't miss the trade. There's nothing worse than getting into it, having it go your direction, and miss out by 10 cents because it actually hit it didn't quite hit it and then roll back over. So keep that in mind. You don't want to get the absolute. Just get that average. Get close to it. And you can actually be a little light if you'd like. A little safe. So here's the helpful indicators, guys. And once again, I'm not a secondary person. You know that. I don't like I don't rely on them as much as other traders. However, in the sideways, they are super helpful. Bollinger Bands is awesome because it actually helps identify sometimes the highs and the lows of the ranges. So Bollinger Band, is it trading at the bottom of a Bollinger Band? Yes, it is. Stochastics. Stochastics is a sign of weakness and strength. When a move is over, stochastics are usually low. So it looks like this downward move is slowing down and it might be stopping. Also, it looks like they're going to cross, which means it could move back up. The power of the move could increase as it goes back up. So that's another good indicator. And then volume. The volume is showing a little bit, it's stabilizing. It's showing a little bit of strength. I don't like the spike in the volume. It's slightly higher at the tops and the bottoms of the ranges, but that could indicate it's turning. You think about that. So we like to see volume pick up. That could switch over the seesaw, right? The supply and demand, so it moves higher. Then when it's at the top of the range, volume could pick up, which turns the supply and demand back to the other side, and it could come back down. So volume's decent when it comes to the range. We just got to make sure that it stays there, after it triggers, I should say. Good. So we got to give it a profit score. Forgot about our profit score, right, guys? Right now I'm ready to hit the button. However, I want to profit score this so I know what options to use if I use options. So we identify the ATR. Looks like it's about 78 cents. We did our math here when it comes to our stop on our entry. Looks like we have the potential to make $2.75 on this trade. And it gives us a scoring of a +2. There we go. So we got a +2. And when you get to the chart here, let's go back to the chart. You'll see that we have +2 strategies. We got covered calls. Long call would be a +2 strategy. A bull call spread would be a +2 strategy. A diagonal call would be a +1. Now, once again, folks, I'm rattling these off. You want to know why? Because I've taken these classes. You haven't yet. So it's nice to have that score. And then you go select out of your tools that you're about to learn the option that you want to use. So there it is, filled out. Let's go ahead. Like I say, you're going to learn the tools with the options. The options might not need any action taking at the abandoned or adjust position. When it hits your stop, it'll sell the stock out, but you might not need to. It might just be a position you just kind of let the trade go and take maximum loss, because you can position size as well as take action for protection. So let's take a look at it. Here is our protective stop down here. We've got our limit, which are our take profit order at the 21.5. Remember, folks, you can bracket order this. We will have a lab, like we always do, and I will set this order exactly up for you on either Thinkorswim or Interactive Brokers or both. We'll see. So we also could change our stop to a trailing stop once it becomes in our favor. It starts to get closer or hits our target. We want to take half profits. We can adjust, so on and so forth. We also have that nice exit of 14 days, meaning, hey, if this doesn't go anywhere in 14 days, my options could expire. I'll have to make an adjustment, or you might just want to get out of the trade if you're doing straight stock. So keep that in mind. All right, guys, look what's happened. Didn't quite work out. So the confirmation worked, and it was crazy because the candle gapped up and went down. It worked out on a red candle, but the next 2 or 3 days look very promising. No adjustments needed to be made because we're only 2 or 3 days in it. But then it seemed to roll back over and fall pretty hard to the downside and really, really fell out of bed here. So thank goodness we had our protective stop. A protective stop gets us out for $17.50 with that manageable loss or whatever you position size the option for. We're good. Exit price, if it's bracketed, the targeting take profit price would automatically expire if they were bracketed together, so no need to do anything there. And then there's no reason to make a trailing stop because there's nothing to protect, nothing to trail. It went straight down. No big deal. If you kept this through the 14 days, it would be a substantially lower loss. That's what's so nice about having a protective stop or an abandoned or adjust position. If things don't work out, they don't work out. So this didn't. But I like the setup. I like how it was. So let's take a look at another one here. I like to do both. This is Southwest Airlines, and we're just going to go ahead and force this. I'll keep it up here, and I could briefly walk it through. So this is a range rally. I think we have some lines here. Yeah, I'll go ahead and get these lines up for you. You can see that it hit resistance area right around, what do we call it? 58.50. If you can see in our chart there, our entry criteria has a resistance at 58.50. We have a support down at 53. And I can see that. We hit it a few times since the beginning of this chart. Rally brings the stock back up to resistance. Definitely up there. We've got a reversal candle pattern there, right? 2 bearish, 1 green, bearish engulfing candle. Taking consideration today's candle out of the factor, you look at the first red candle from today's and the green candle after. So those the 3 candles of the last 3 days is what I'm talking about. That's a bullish or a bearish engulfing in the range of 58.50. Looks like it's confirmed there. Identified our test. Looks like we've got 18 days on time frame. Remember, you just take each move, top to bottom. Figure out how long it took to go from one to the other. Sample size. It looks like 1, 2, 3, 4 times. So you get whatever those averages, divide by 4, and that gave us the 18 days. The entry is going to be 57.70, which it looks like it's the low of the previous day. And it looks like it's confirmed because right now it's at 57.60. Our protective stop is going to be 59.50. Looks like the top of the Bollinger Band this time. You guys can see that. Top of the Bollinger Band. And we are going to target this thing at 53.50, which, once again, not quite the support level bottom. You notice, see our support level here says $53. However, our target is 53.50, 50 cents before. So we're not being too greedy. We went ahead and took our entry and our target, and we came up with a potential $4.20. We had an ATR of $1.10. It gave us a score of 3.82, which is a -2 outlook. So let's briefly go through this. There's our stop. Up there was a Bollinger Band. There's no Bollinger Bands on this, but I believe that's what we put at the upper end of the Bollinger Band. Our limit, take profit order, down at 53.50. Not quite the bottom of 53. Looks like about 50 cents less. Got a beautiful bracket order. One triggers the other, so if it goes down and hits our take profit, it'll cancel the stop. Or if it goes down to our limit order and we want to protect the gain we have, we can change that stop to a trailing stop and kind of squeeze it further. We also have the luxury of the whole thing being gone in 18 days if you set it up that way, or making an adjustment after 18 days regardless of what has happened. So this is a fun one because we decided to go the opposite of the last, didn't we? So our entry point was beautiful and looks like we had our target extremely quickly. Well, it looks like about 4 or 5 days. So our protective stop was not needed, and maybe if we got to that limit and didn't take all of our profits, we could have adjusted our stop to a trailing stop, right? So there's our limit. Definitely took profits there at some point, either half or some. Adjusted the trailing stop so it can continue on and maybe follow this thing as it falls. But look at our time frame exit. Many options trade will use the time frame for exit. If your time frame is 30 days, that's 30 candles. You're sitting pretty. Even after 18 days, though, guys, we could count down 18 days that you'd be sitting somewhere in the $45, $44 range. Isn't that nice? So that worked out pretty good. All right, guys, let's do a little bit of the range-bound summary. And I'm gonna go back a little bit because I really think you guys need to keep this in mind. You have to identify that you've established a range. You got to have 2 or 3 highs that match each other, 2 or 3 lows that match each other, and you need those moving averages crossing over. Okay, you need them. You don't want them both above the price action or both below the price action. You want them to be pushing and pulling between the two. Okay, it's muddled. Then between the two, the range rally exit high or entry high or entry low, it doesn't matter. You're identifying if you're at the top part of the range, it's a bear rally, right? You identify it as a pivot point to the downside. Same idea. It's got a trigger below, confirm the pivot. The previous low was the target, just like a bear rally, right? So keep that in mind. Now, if you're at the bottom of the range, it's a bull pullback. It needs the pivot to stop it from moving lower. You'd like to see the pivot at that support level, which is that range, and your target is going to be the previous pivot high, just like a bull pullback. So you're doing a mini bull pullback or a mini bear rally in a sideways setup. So keep that in mind. Trendless sectors, basing industries, things that aren't necessarily exciting, things that aren't really going anywhere, but just kind of muddling forward. I'll have to say that summertime trading is usually pretty helpful. Lower volume situations, just after earnings, where there's, okay, here we are, we're moving sideways. You'll see after things gap up or down, they usually consolidate. Now, there's your difference there. Consolidation, wait for the moving averages to catch up, because consolidation can turn into range bound or sideways once they catch up to the moving averages, and you can see price action going up and down through them. If the moving averages are trying to catch these things, remember, it's consolidation. It's not sideways. All right. You know the rest. Complete your tests, go through the setups, check the boxes, do what you need to do. Plan your trade and trade your plan, guys. Always play with these. They're so fun, and they'll fail a lot, they'll fail a lot. I mean, that's just how it works. Sideways usually breaks out eventually. Stocks don't like to go sideways for very long, but sometimes they do quite a bit. So it's nice to be able to sit there and say, okay, I can play this stock between this range for the next few weeks or month before the market surge out or it has its earnings or it breaks out and it becomes an uptrend again. Then we move back to our uptrending stuff, our ascending triangles, our bull pullbacks, anything that's bullish. So keep that in mind. That's why you got to have a plan for everything. So you're going to come across these. It's funny to me, guys, and I'm going to say, you find your sectors, industry symbols, sideways ranges. Usually you'll just find these. You don't really need to scan for them. What you're going to do is you'll be looking for, okay, the markets are up. I'm doing my top-down approach. I've got a sector that's strong. Okay, the markets aren't really up. The markets are kind of consolidating, but I'm not finding any bull pullbacks. I'm not finding any bear rallies. If I'm not finding any uptrends. You've probably found yourself some sideways. So it's kind of neat. It's sometimes very hard to go find sideways in a trending market. If markets are correcting, you're not going to find sideways. If they're breaking out, moving higher, you're not going to find sideways. However, if you find yourself having a hard time finding bullish and bearish trades, sideways might just kind of present itself. So don't make it I wouldn't make it a goal to go scan for sideways. You can. I mean, you can always find a bear market, a bearish stock in a bull market and vice versa. So you can always find some sideways, but keep in mind, this is just something you want to keep in your satchel. It's one of your tools that you can use when needed. However, you want to make sure that you follow the rules of your plan. A reversal candle's key. It needs to hit that range and show that it's going to pivot there. If it makes that pivot point, whether you get into it as it pivots or the day after it pivots, I don't care. That's going to be pretty cool because now you've got yourself a good setup. Whichever one you decide to do, get in early, trade your plan your trade, get it done. It's kind of frustrating sometimes, guys, when you go through and you build this beautiful trading plan and the next day you're in and out for a loss. And you're like, oh, why did I got to start all over again? That's fine. The discipline of walking yourself through that plan every single time will raise eyebrows and give you kind of, if there's something you missed, it'll give you a third or fourth or fifth chance to actually pick it up. So start the plan the same way every time. Treat every trade the exact same and go from there. All right, guys, thanks for joining me on our sideways trades. These patterns are actually really cool and they can sneak up on you. They're fun. Go out there and practice them if you come across them and make it yours. Thanks for joining me today, guys, and we'll talk to you soon. Bye-bye, everyone.